The annual stress test, I think it was a given. Nobody really expected any of these banks to fail. But what's the big takeaway about the investability of these banks going forward, knowing now what we know about these newest stress test results?
Yeah, hi, Dominic. I would agree that nobody expected any surprises really from this stress test. These were scenarios that were developed before the Silicon Valley Bank failure and based on year-end 22 type numbers. So while it's certainly a positive, it's a passing grade, largely for the banks here. Really, the next steps we're looking at are how does that convert to the capital return, which we'll typically we'll see on Friday from the banks in terms of buybacks and dividends. But also, I think more importantly, this is just a stepping stone on some other requirements that are coming down the pipe, which would be the Basel III endgame requirements, likely to move capital ratios up even additionally. I mean, these ratios only go one direction, which is up. And then, of course, more strict, severe adverse scenarios next year, testing for additional things like interest rates moving higher versus lower, which typically happens in a recession. So that's caused a lot of problems with the securities portfolios of banks and the valuation. So still a tough road ahead for many of these banks.
All right. So there was a time, an era, if you will, when investors viewed banks as capital returners, right? Dividend payers, buyers of their own stock. It really helped enhance the return for shareholders there. I wonder, can investors still treat these banks the same way? They're healthy. The Fed says so. Can we expect them to be the magnets for investor capital because of things like shareholder return?
Yeah, I think so. I mean, what doesn't kill banks will make them stronger here. And so it's certainly much safer from a capital cushion perspective. There may be a bit of a pause here with respect to capital returns. And I don't think that's necessarily a bad idea. If you look at the yields right now, valuations are, quite compelling. 4% and 5% plus yields. We've got price to earnings and price to book ratios that we haven't seen in many years. Regional banks in particular got very hard hit during the March Silicon Valley failure. We're still down about 40% on regional banks year to date. So a lot of value there and great yields, which we think are only made more steady and confident in those dividends given these a passing grade here.
Stephen, we've just got a few seconds left here. Favorite picks amongst the banks?
So I think it's you're safer in the largest global banks here, the JP Morgan, Bank of America, Morgan Stanley, I would highlight. And then some of the very strong super regionals we'd highlight, like US Bancorp, Truist Financial, PNC Financial. These are companies that are very well diversified, have great service territories, well capitalized, and I think can, if anything, benefit over the longer term from the consolidation that's likely to now take place in the bank arena.